Let's turn now to some big moves for retail stocks. Walmart hitting a record high, finishing near the top of the Dow after reporting solid Q3 earnings this morning, driven by strong revenue growth. Company also raised its full-year guidance, and Lowe's is moving, though, in the opposite direction. Despite beating on the top and bottom lines, the company said it's expecting sales to decline in 2024. Let's bring in Telsey Advisory Group CEO Dana Telsey. Dana, welcome. So it sounds like from the commentary out of Walmart, conditions overall for the consumer aren't changing much. Consumers sort of hanging in there. How does that bode, do you think, for the holiday season kicking off in just about a week?
Thank you for having me, John. I thought Walmart's results were terrific. It really shows what they're doing in order to activate the consumer. Keep in mind, they just got a bigger share also of some of their higher income households, and so they're gaining share in a time when the consumer wants value. What does it mean for other earnings coming up? Frankly, discounters and off-price are what's working. I expect tomorrow when we hear from TJX, we'll continue to hear traffic drive the sales gain. I'm looking for sales to be up in excess of 5% for TJX. And I think, keep in mind, general merchandise improved at Walmart also, which hopefully bodes well for Target. But Target has 48% of their sales allocated to general merchandise, whereas Walmart, 60% is to grocery and essentials.
So what about Lowe's, especially in light of what we heard from Home Depot? What's the sense around some of that bigger spend, and maybe that spend that's not necessary to get through the day or through the week?
I think overall, when you think about the home improvement retailers, the inflection point isn't here yet. We need continual rate cuts in order to be able to drive an acceleration in the top line. And think about what you saw at Lowe's, where the big ticket goods still didn't work very well. They were softer, yet they were able to raise their sales guidance while trimming the operating income a little bit. I think you're not at the inflection yet, but you're on your way both for Lowe's and Home Depot.
So, Dana, looking to Target specifically tomorrow morning, I realize it's probably the most direct peer to Walmart, but it also tends to be more skewed toward discretionary spending as well. So not only the read-through from Walmart, but also what an incoming Trump administration is going to mean for some of these big box retailers, especially names like Target, where tariff exposure could be potentially large.
Yep, when you think about the tariff exposure, it's something we're very concerned about. We just wrote a big piece on it. Overall, what we're seeing is, look what Walmart said, 60% of their goods are made or grown in the U.S. You take a look at Target, where 48% is general merchandise. They're going to have work to do. It's been said that certainly with tariffs, apparel is going to be one of the areas that needs to diversify the most. And with those tariffs that could be incoming up to 60%, could we see double-digit price increases? That's not good for Target or for any of the apparel retailers. And that's why you're seeing more of them accelerate the pace at which they diversify their sourcing. Product innovation and newness is definitely what matters. Target certainly has that with a lot of their collaborations and partnerships, but price matters also. We saw in the last time that tariffs were increased, companies were able to navigate, but you're watching in order to be able to see how much do you have to raise those prices, and that still remains to be seen. When you think about 2025 guidance that's given in January or February when companies report their holiday sales, we could see operating margin pressure from the tariffs, given it's not for free to diversify your sourcing, because as many say, there's no China like China in producing these goods at lower cost and expertise in manufacturing.